Hi, it's Harry Dent on May 9th with a market update. If you've watched us on CNBC and other programs, we've been looking for a peak later this year, probably mid to late summer, and some type of correction before that. But we just had some important surprises in the markets. Number one, we've had this megaphone pattern in the S&P 500 where we've gone a trend line towards the tops and the bubbles in 2000 and 2007 that hit at 1600. Right here currently. We broke above that. Now that's the first major U.S. index to do that. The Dow and the Dow transports hit higher, about 7% higher, around a 16,000 Dow, probably later this summer. But this was a key break, and it means even if we correct a little bit near term, stocks are probably going to go a bit higher later this year before we hit stronger resistance and more charts like that. The second big surprise was gold. Gold had a major run from late 2008 to late 2011, a major surge, went sideways for a couple of years, almost 2 years. Now, normally, all the charting I've done in the past 20 years, you move sideways after a move like that, you break back up and then peak. Did not do that. We've had bad news from slowing demand in emerging countries in India and China with the commodity slowdown. But I think a lot of hedge funds, like oil in late 2008, were just forced to sell on high leverage, margin calls, and gold just had almost a flash crash. So gold's now in an in-between stage where we've broken below $1,525, very key support. We could go as low as $1,250 by our projections near term, or we could break up to $1,525, retest that peak, and start to head back down long term. So gold could still go to a new high. And we'll keep people updated in our newsletters and things like this in the months ahead. But, you know, stocks look more like they're headed higher. Gold could go either way. And the final trend we're seeing here is junk bonds, high-yield bonds that have gone to unprecedented low yields with all this Fed support, and the economy is going to grow no matter what, and endless stimulus. We look like we're seeing a peaking pattern in junk bonds. They will peak first if the economy slows ahead with all this sequester stuff and tax hikes and spending cuts. And then other bonds will follow. So we're telling people now's the time to start selling high-yield junk bonds and maybe on a lag corporate bonds and somewhere down the road treasury bonds. So again, we see major decisions and trends for stocks in the markets this year, and we want to keep you updated. Thanks for listening.